All right, so welcome to another. I think we're trying to do this macro discussion. Let's see how this goes. We had some good fun last time after FOMC meeting, which was definitely a big shocker. After that, I think we had reasonable amount of correction in the market. Today we had another one, which was almost like kind of the one of the most boring one, I would say. There was hardly any reaction from market after the Fed meeting. And it is kind of understandable because there was no real news. Everybody was pretty much aligned on no interest rate cuts. And for a change, I think Jerome Powell was also very neutral. He did not, even though the first reaction from market was when they removed the wording that it is the inflation is moving towards 2%. Now they actually just said they removed all the wording and simplified it to inflation is still somewhat elevated. That was seen a little bit of a hawkish move from Fed. But the good news is that when we saw the actual press conference, Powell actually clarified that it was more of a simplification of the language because now we are in a more like a pause environment rather than and waiting. Basically, the summary of the press conference was that they are now in wait and watch mode and looking for data and not trying to be super aggressive like they were in the last quarter. So overall, I think market took it in stride. It was doing well, and then I think now quickly focus shifted to the earnings. We had some big earnings, three of them today, which we were watching. Tesla, Microsoft, and Meta. I think all of them did pretty well, and I think the biggest implication, of course, was I think DeepSeek is the big news this week, which has been hurting AI trade. So everybody was also watching on what is really going to be said by these big players. Interestingly, I think there was no, of course, means we expected, and as I think as the all access subscriber know, we did talk about it on Monday in our note that we don't expect any major change. In fact, even though the market was panicking about this whole DeepSeek release, we had talked about this that this is not really a big change, even if it gets cheaper. Let's assume, of course, there are a lot of questions about it, whether it is really they managed to do it in low cost. There are all these theories around how much of NVIDIA hardware they are able to get from Singapore route and so on. But let's not get there, even if it is cheaper. The basic idea is that this is not like something which either Meta had not done. We were already talking about Llama models. We had similar discussions last year on how the models will become cheaper and training will get, there will be innovations around it. Main idea here is, do we expect AI trade to fizzle out? And what we saw from today's earning, Meta has talked about hundreds of billions of dollars to be still spent on capex over next few years, including they're already doubling their capex this year. And in fact, they came out on the top range of it. Like they had originally predicted 60 billion, now they are saying 60 to 65. So they are actually increasing the capex. And then we look at Microsoft did say that they're maintaining their 2025 growth of capex. And what I would say is the only negative comment which came from them was that 2026 is kind of demand driven. So what demand driven means that people are taking it a little negative that probably they're looking at reducing capex. But I think that is just to summarize, I think AI trade, we did not see anything specifically negative. In fact, most of the earnings talked about that. In fact, even Tesla, even though they did not share it in the earning, but they released image of their 50,000 NVIDIA hardware cluster, which they have put together in Texas, and they are talking about the self-driving car. So I think people have probably missed out on that, but there is even from, the next stage from LLM, now we are talking about whether it is Tesla self-driving car or robotics. That's what NVIDIA was also focusing on. So I think that is another story which probably will come across. So I think from our perspective, we are still pretty bullish on overall AI trade. But now coming back to the, I think, earnings and what Fed is talking about, let's have a quick discussion, and I would open it up for comments here on what everybody is seeing and if there are any quick questions on this. So if no specific questions, let me quickly look at the charts here. So as we know, right, means we in general in the market we are. I mean, this is almost like a 1 year chart of SPX, and you can see that we are sitting on a pretty solid bull run. The correction we saw in early part of the January, I would say this is what I am been looking at, and we have been talking about the yields, the 10-year yields. So if you see, we had a pretty bad, rise in bond yields, and we peaked on 14 January or for 14 or 15 January, and that is exactly where our correction ended around same time. We saw the SPX correction ended. So I think market concern about inflation is more or less now stable. Like we had a decent number on the inflation, which really helped. And that is what I think is the driving the market. And if we just ignore the AI issues which propped up this week. So this is, I think, looking like pretty solid run. And I would say that at this moment, as long as the bond yields are stable and we are not seeing any major concern here, I think we should be not worried about that. And let's look at the bond yield, like this is the yield curve. And if you compare this, these are basically just the chart here, which is a 1 month ago and 1 year ago. If you remember, most of the concerns on the inverted bond yield curve, that is all gone now. And we are talking about the term premium. And this was a very interesting question, even in the press conference today with Powell, where they talked about uh, what is the Fed concerned about rising long-term rates? And if you see here, I think this is mostly a term premium now because we have a pretty much standard yield curve where term premium is increasing. And that is pretty normal and I would say healthy economic environment, which we are looking at right now. So this is one thing I wanted to just focus on at this moment, like, where we say macro wise, we are not seeing any major issues here. And whether Fed will cut rates, probably not in the near term. And that will also be they also try to pull back on their narrative. If you see the minutes which came out from the last Fed meeting, there were discussions around tariffs, there were discussions around potential inflation rising. And this time what they did is they tried to pull back on that. In fact, when press pushed Powell to make a comment on Trump's tariff, he tried to walk away from it. So that looks like much more neutral stance, which is helping the market right now. So that is the narrative outside the, I would say, AI trade. And I think the earning reaction has been positive for Meta. I think Microsoft has suffered a little bit because of the growth concerns. Nvidia, and as we discussed the AI trade, so this is what we are seeing. Like there is hardly any reaction because capex is still good, and Nvidia is right now. Hopefully it has found the bottom after the initial DeepSeek reaction, and I think Tesla is reacting positively. So these are, I think, the earning plays today, and at this moment, I feel like we are mostly waiting on earning driven market reaction tomorrow. Like when I think Apple is due tomorrow, is as far if I remember correctly, and then we will probably see a couple more. I think Google and Amazon will be driving some of this narrative for some more time. So that is where we are today.
So,
And yeah, go ahead.
Raman, may I interrupt and ask a question?
Yeah.
So, I have two parts of the question. One is overall market. We are still sitting even after the recent dip on 2 years back to back. 20% plus growth in S&P. Has that happened in recent history? I'm not going back to 1929 and stuff, but
Mhm.
in recent last 10, 20 years, where we had 3 years of back to back positive 20% kind of S&P. So that's first part of my question. And the second one is any comments on Nvidia's PE versus other companies like that?
Yeah. So I think first part is I would say definitely we are in a golden run. So let's maybe it's very easy to see. We can go to a weekly chart and talk about what we have seen. So this is my old analysis. So let me just quickly delete this. So definitely we have been sitting on a pretty much very, very long bull run. if you go all the way back. Definitely not 20% plus kind of rally. If you see the slope is pretty good, but we did see after COVID, by the way, we had uh, almost, I would say, 18 months, if not more, or maybe almost 2 years of bull run,
Yeah.
which was pretty steep. Um, and then we had this 2022 correction when we went on a rate hike cycle, which was definitely, which compressed a lot of these valuations here, especially on the software side. And definitely it's again another bull run. So I would say it's not uncommon if you look back much longer history, but kind of money printing which happened since COVID, that has led to these two major bull runs. And in the middle, we did see a blip because of, again, the money flow. So definitely the kind of bull runs we are seeing, to answer your first question, no, I don't think so. We have seen this in recent times. Definitely, only other two times you can remember is in the dot-com time, when the market did do very good for multiple
Yeah.
years.
Yes.
And then, of course, we call it roaring 20s, which we discussed in our investor day also. So right now, definitely it looks like a golden period since COVID. If you remove the correction of 2022, which was actually healthy. If you see, this really helped set the stage for the
Yes.
next bull run. So is it
Yes.
possible that we can have another similar correction? Yes. But to answer your second question, whether we are sitting on pretty high P's, I think most of the cases, the growth rates are very um, healthy. Like if you see the tech companies which are leading this whole high PE range. So Nvidia has been on high PE, but it doesn't mean that they have not delivered on the earning growth. So forward PE is what is more important than the current PE. So most of the, if you see the tech companies, their forward PEs are in the range of 30 or 35 in the worst case, which is not very high versus where it has been historically. So that would be my answer. But yes, if I hope I was able to clarify that. But to
Yes.
be frank,
Thank you.
P is less of a metric in a world which is changing so fast, and the kind of expectation from AI which we are seeing, or the technology growth we are seeing right now. So that is main reason, I would say, which is causing this kind of a bull run. And as we have discussed multiple times, this whole bull run has been driven on AI because of the expectation of the earning growth, and many of these companies are already delivering. So I have Dhaval, you have a question? Please go ahead.
Yes. Related to what Naresh asked, what do you see as the similarities with the dot-com bull run and dissimilarities at this point? And then where do you think we are based on the similarities? If there are
Yeah.
enough, then are we in 98, 99? What? So can you answer that?
Yeah. Yes. So I
Thanks.
think it's a good question. I would say dot-com time, the earnings were not matching the kind of euphoria we saw. It was more of expectations of the tech changing the world. We are somewhat similar in AI. I think there is a lot of hype, and valuation have sometimes run away, but in some cases. But this time the difference is that there is a lot more spending, which is and plus there are revenues. I think if you see Microsoft growth of revenue, if you see Meta, which has done huge spending, so it is different in the sense that we are seeing actual earnings following the hype. It is similar in the sense that valuations are very high in the market, and there is very huge expectation from the AI technology. So that is my short summary. Again, nobody can foresee, and even though history repeats in terms of overvaluations and crashes, it's never the same. So how
Right.
far we go is impossible to judge at this stage. So that is what I would say. But this is why I think most important thing now would be to keep watching the earnings. Like if you see Meta earnings, as I said, is the Meta is like always people are underestimating how fast they are benefiting from AI. It's not a direct, easy to understand company, like because ultimately they make money on the ads and all the recommendation engines and so on. But they have been one of the most prolific user of AI. And right now they are throwing a lot of money behind it. They are relying on this to become the kind of a pull, if Google has enjoyed the whole search history for last 2 decades. Probably that is the holy grail right now. Everybody's chasing, and Meta is in great position where they can probably change the way people get information using AI. So that is, I think, the thing which everybody's going after.
Yeah. So I think if we go with the similarities and dissimilarities you painted, which I tend to agree also, in that case, you would equate this. I mean, it's tough to draw parallel exactly to the 90s bull run, but if you talk the similarity, the dissimilarity of the fact that we have earnings right now, right? So there was a time when Cisco's earnings were justified too. Then it got too much, P of 180 and all. It happened in 2000 March and all that after the split, before the bust. But I was at Cisco that time. So given that, it looks like we are in the early innings because earnings are still matter and they are.
Yes.
So then
See,
that means we are in probably 97, 98, not in 99, 2000. If you just take that analogy, that
but my
part of the
question
analogy.
would be, my question also would be, there's no absolute numbers, right? You cannot say 180 PE is the
I
target for any bull
wanted
run.
to talk to you. One second. I wanted to talk to you 1 second.
Yeah. So,
Sorry, Raman. Please repeat.
yeah. So what I'm saying is that
Sorry about that.
180 PE is not the one of the target, right? So what I'm trying to say is that already it's a matter of stock market always tries to the market is priced for, let's say, next 18 months. Market is not priced for what is happening today. So right now the panic this week, the panic started because people are saying, are we in the late stages of growth? Is the spending going to reduce on the hardware? And the answer coming from hyperscalers as of now, based on today's earning, is not yet. But there was a hint of it that we will see in 2026 by next year, whether we continue or not. That's what Microsoft said. While Meta is saying, no, we are committed to major spending. So it's very early to say that it will be similar, whether we will hit those. Well, if you see last year, we actually hit 180, 150 PEs also. But then the earnings quickly ramped up and justified it. And now we are back to over 40, 50 PEs. So it's not, PE is never a good metric, I would say. Let's not compare PEs only. It's a much bigger context which matters. So that is how we will say.
I should have said PEG. I should have not said PE. I should have meant PEG, PEG, PE to growth. So Cisco
Yes.
PE to growth, but PE to growth of NVIDIA has always been quite reasonable. In fact, it improves. PE to growth has been improving, as you've been pointing out to on the finance channel. But go ahead, you were saying something before I make my other comment.
So I
Go
think
ahead, you finish.
so other than that, I would say just it's a matter of how do you see the the trajectory. So market is pricing the next 2 years. Even if, let's say, we have another peak, let's say another 1 year of peak earning, it has to happen. But if we start seeing signs of slowdown in 2 years from now, market is not going to wait for the peak growth. So it's more about market is always trying to project where you are. And usually we say that stock market tries to price in 18 to 24 months, and in some cases 12 months, if depending on the visibility in the sector.
Right. The only other two comments I had with respect to DeepSeek. So DeepSeek has created a shock on the cost side, right? They are saying, hey, you can do the same thing for lesser costs. So of course, cost is an input to various companies. The valuation should go up, in fact, because their expenses are going down, like Meta and other people maybe. But on the other hand, even the folks who are buying the chips, right? And the chips provider like NVIDIA, there's a long runway, right? The cost may be down, but that doesn't mean the addressable market is still not big enough that they can sustain the run for next few years in terms of their capacity, right? Because NVIDIA is at capacity. Even ASML and all that reported recently, they show that still the demand is huge for NVIDIA, right? Taiwan Semiconductor, ASML, they are all correlated to NVIDIA demand. So that's one point. And second point, obviously they have to say something in the press conference. If Microsoft doesn't say anything about looking into spending, then they look very irresponsible given what happened with DeepSeek, right? They have to at least say that, hey, we're going to look into it and see if we can save money by spending less on NVIDIA. So they may spend less, but then it may be elongated over a longer time. So that way NVIDIA may still be in a very good shape.
Sure. No, I think, again, let me not comment specifically right now on NVIDIA or anything. Basic idea here is nothing has changed. The market is sentiment driven this week. So that's what has changed. In terms of earnings, we will see. But on the other hand, let us also not get overconfident about it. That is the discussion, right? It's a matter of I don't think Microsoft either said that it is because of DeepSeek they are looking at spending. They are saying it's a demand driven. Because it ultimately it's Azure. And as I think there's another question in the chat, let me quickly address that because this covers part of it. So the question there was, what is the view on Microsoft report on slow Azure growth? So this is, I think, another thing, right? That while they are spending, while AI is supposed to change a lot of things, there is growth rates of Azure are not matching up, and they must be worried irrespective of DeepSeek or anything. It's a matter of can they justify, because right now we are looking at spending of the scale which is never seen before. Like we are talking about spending going from 10 billion to 20 billion to 40 billion. Like, this is the scale each company which is where they are spending has been never seen before. So there is another concern which market has, of whether this can be sustained, whether the growth rates can be sustained. And let's say when we talk about hyperscalers, these are software companies we are talking about. If you see even NVIDIA, if you look at their recent presentations, they have started talking about the next level of AI, which is beyond LLMs. You cannot just stick LLM as a use case where you can throw so much money. Then you have to justify whether there is enough market for that. Now, beyond LLM, we are talking about robotics, we are talking about drug discovery, we are talking about so many other things which NVIDIA has discussed. So let's not get into purely NVIDIA here, because that is not the intention here. We have limited time today. But basic idea here is that LLM and AI is one part, and market is focusing too much on it. And as we have seen before, you never know where this capex spending or the computation needs might take us. Means as I discussed, even in Tesla side, they are showing this cluster of 50,000 GPUs, and they're talking about how that is absolutely critical for autonomy in terms of the self-driving cars. They're talking about robotics. They have their own Optimus Pro and so on, which they are developing. So all those things are matter. So now, just to answer Tanuj's question about the Azure slow growth and will it affect the AI rush? My comment on that is, we are seeing, like, Azure is just one of the piece. We have other hyperscalers. We have Meta, which is not even providing cloud services. They are themselves internally being one of the biggest consumer product. Like they have 3 to 4 billion, they claim, users across their various platforms. They are able to use and internally and able to spend almost at the level of hyperscalers. And similarly, if you look at what Tesla is doing with their self-driving, similarly, if you look at what potentially a robotics company of Tesla scale can do, if we consider self-driving cars as a robotics company. So there's a lot of unknowns in AI of which use cases will be successful. I think Meta is betting on it. Tesla is betting on it. And these are outside Azure. These are outside hyperscalers, which are purely, platform providers. So AI has a lot bigger story than one or the other when we look at what Microsoft is saying or what Meta is saying. So that is my response to whether it will affect AI rush. I don't know yet. We have to take it as a whole. We have to take it as what, if you look at Meta itself, it is way bigger. They are still growing. Their earnings were great, and they are still betting on hundreds of billions of dollars spending in future, not what we are talking about. They have already done. So that is a lot of unknown on how it goes.
Can I make two quick comments? One, anybody else? Otherwise, I wanted to make quick comments. One is, do you think, Raman, the Azure situation, is it a function of market share being taken away by other cloud providers, or is it the pie concerns? Point number one. Point number two, Meta, besides using their stuff for their products, consumer-facing products, they obviously have open source Llama, right? So they must have some plans in mind why they are spending so much to maintain Llama as an open source. There's costs involved. They're not getting any revenues. What is the end game for them with Llama? Sure. Will they do a Red Hat on Llama? Will they do consulting and make money? Or what? Those two questions if you can answer. Quick questions.
Yeah, so I think when you, again, I have not dig deeper today yet on the Azure slowdown specifically. So I have to go through all the details because there was multiple earnings and so on.
Yeah.
But I would say to answer Meta's thing, because I'm very clear, I think Meta has a bigger game in sight because they have huge revenue coming in purely from ad business. And as we are seeing, my view is that the search is up for disruption. And imagine what Meta can do if they become the first source of, they already have the user base. Remember, the only two companies which have the biggest user base is Google and Meta. So if Google is faltering, Meta can take over that kind of if AI will become the basis of search, that is where Meta is going after. That if everybody is using LLMs to search everything, I think Meta has a clear goal. So if people are saying they don't know what Meta's end goal is, it's very clear to me that Meta's end goal is to go after search. And that is what every LLM company, if whether it's OpenAI, whether anybody, nobody is going to be able to make money on just $20 per month subscription or even API business. And that is more of a middleware. The end user game is search and ad business, which is what I think everybody's after.
Yeah. So your point is that even though Llama is open source and anybody can build search on top of it, right? Not only Meta, but Meta has the users to connect to, so they'll have the advantage, and hence
That's right.
they have
That's
the
right.
inputs to the search, right? That's the main advantage versus other competitors who may also leverage Llama for search, but then they don't have the users to funnel into. Okay.
They have the biggest distribution, like what I've said.
Okay, thanks.
And that's pretty much the only advantage that Microsoft has it too. Microsoft and the rest of the people, basically they are the first one to make money because they have distribution. Other than that, it's hard to make money. And if Meta doesn't do it, they missed the boat on phone. They didn't do it, and they were at a point where they were going to get thrown out of Apple because of other things, and there's almost had existential crisis. They can't afford that next time, so they have to be on top of it. That's why they spent so much money on Oculus too, because if Oculus were to take off, that whole computing platform, they would have been screwed.
Right. The App Store
So
over there.
they have, and plus they actually have a ton of ways to make money out of, all the way from like 3 billion people on the damn platform. I mean, there's just so much money they can make out of this thing. Everything will get automated. So I think it's a complete sense.
Yeah, I think there are multiple end games here, right? So I think on the software side and distribution side, as we discussed, it's purely ad business. Google is faltering. I think nobody's talking about Google right now. That's interesting, right? Means Google is still owning. People don't realize how much money they're still making on search. And the end goal is that nobody wants to search anymore. And then the final thing is which Amit made a very good point. AI, biggest money initially Microsoft made because of the enterprise business. They are the biggest distribution on enterprise side. Then consumer side. So there are multiple vectors here. And then we already discussed there is a huge vector on robotics in AI. There's a huge vector on the new use cases. So AI game is multifold. I would say this is where we have to watch where it goes. At this moment, just to summarize again, at this moment, we are in almost like a stable macro environment where the interest rates are coming down on short-term side. Long-term rates are showing no signs of either going too high or too low. So we have more predictability coming in 2025 versus last 2-3 years. So just to talk about where we started on FOMC and so on. So predictability of the interest rates, and almost like we can say we are flattening the yield curve. We are looking at 4% short-term rates and our long-term rates are, which is 4.5 and 5, which is like we are almost on a flat rate curve with some term premium, which is fair in a market. And we are now purely relying on the innovation. We are purely relying on whether AI can really make actual earnings happen. I would say this is one of the most, basic research-driven market. Now we can actually see where the real market is going. We can worry less about that we will have interest rate rising again. Thankfully, the inflation numbers are coming out good after with the huge rate cuts, which was started like 100 basis point, which was cut by Fed. So that is where we are today. Again, we can do a lot of analysis on AI or all these companies. Today, earnings are still looking like we are growing very well. So again, if I go back to S&P 500 earnings, they are on positive side. So whether the bull run has a lot to run depends on the projections now, not on today's earning, but on projections on next 12 months, 18 months. And we are right in the middle of the earnings cycle with some of these big names coming out today. It will be, let's maybe discuss in another 2 weeks or 3 weeks. Probably we will have even better data on what these guys are projecting. And we can talk with a little more data behind us rather than speculating on what's happening. Because right now, only one of the hyperscaler Azure has come out. What if we see actual slowdown on all of them? What if and then we can answer these questions also, whether it's a market share issue or whether it's a industry issue, whether Google Cloud is saying slow down, whether AWS is saying slow down. All these things will come out very soon. We don't have to wait too long. So let's look at that and then we can discuss. We are running out of time actually. So we wanted to keep it short today. Just a couple of, if we can take one or two quick questions if anybody has. Otherwise, I think mostly our goal was to just create this platform. I think it's last time we had some good discussion after the FOMC meeting. And today was another FOMC meeting and also these interesting insights into the earnings which came out. Any quick comments outside what we have discussed?
Does it mean actually the way things are going, sort of the index trade is, if you think about what Berkshire is doing and a lot of people are doing, it's basically calling the index trade to be not that lucrative this year. I mean, I don't know how to put the question, but essentially it just seems like if you need to make money now, you got to research, you got to get into the detail, you got to figure out where to put the money versus just, spray and pray that has worked in the past. Seems to me like return is not expected to be very high on just like basic 60-40 strategy. Is that a right thing to conclude? I mean, for this year specifically.
So if I take two parts of the question, let me first, easy one, 60-40, it has not been working already. I mean, if you see the bonds have done really bad in 2022, it has done reasonably bad in 2024. So equity always was beating. If you take last 3, 4, 5 years since COVID, equity has beaten 60-40 portfolios very easily. Now, second part of the question is when you say index investing versus stock picking, it's a very difficult debate because if you see index itself now is driven by 3 or 4 companies. Like if you see most of this AI trade, like if you say Mag 7, if you just pick Mag 7 versus index, you will probably do even slightly better, and they actually contributed to most of the index. So we are living in a AI trade market right now. We are living in this Mag 7 market. So whether it will continue, it depends on whether these Mag 7 and these big cap stocks, which are really driving the index, diverge. So if one of them falter, like for example, Google is nowhere in the sight. People are talking about Microsoft, OpenAI, Meta doing all this great. Means if one or two or three of them start faltering and the index becomes flat, yes, right. That is, I would say yes. And that is where I think probably we are heading because we cannot have consistent growth across the segment. As we are hitting the peak of this whole AI boom, there will be times when we'll see one or other will falter. So that is where I think we have to watch out. So I don't have an answer, Amit, to be frank, like whether index investing will not be useful because if NVIDIA doubles from
I think the reason why I was saying that is a lot of money are sitting on a lot of people are sitting on a lot of cash. It actually increased. If you just think of them, year over year.
Sitting in cash never helps, right? Sitting in cash is never helped. Okay, let me answer in another different manner.
I mean, sitting in a cash in the mean, just, put in the bonds, it's got 4.55% yield right now. People just don't think that it's easy to beat, 5% yield without taking substantial amount of risk. That seems to be the threading on.
Yeah. So let me answer in a slightly different way, in self-serving way. Like, with Proflex All Access, we ourselves have beaten the index for last 2 years by 2x. So index investing.
No, but that's by stock picking. That's my point. That's why picking stocks, not by, that's what I'm trying to say.
Yes, so stock picking helps. What I'm saying is even in a good market, even when index is doing well, stock picking helps. So that's my point, and that's what we believe in. Like, why to invest in a basket when you can really do the research and you can focus on a good stock? Like, if AI is driving the market, then focus on AI leaders. Why do you want to pick the whole index and keep the laggards with you? That's my thinking. Maybe not. I understand that it's different philosophy for everybody when they're investing, but basic idea here is that index investing is great for people who want to be passive and who do not want to put in the work. But if we are willing to put the work, stock picking always has worked better. That is my personal view.
Sure, makes sense.
And in this year, if you say it all depends on whether we have a consistent, tech growth, and definitely that will be a difficult question to answer in a short term. It's more about whether AI continues growing. If all these stocks keep growing. Let's review this. Maybe it will be a good time to discuss this after all the earnings are out and we have better view on even this current quarter, right? Means every quarter to quarter it's different. I will probably have a different answer if I see the divergence across the Max 7 or the tech players on the earnings itself and the outlook changes.
Yeah, I guess we call it a day now.
Yes, so thanks everyone. I think it was a great...
Raman, I had one comment if you agree. So looks
Sure.
like we are in Goldilocks for now, given post this Fed meeting and the messaging in that. We seem to, here's my statement, we seem to be in Goldilocks until we get a bad inflation number probably, or some other shock, random shock.
I would not like necessarily call it Goldilocks
Okay.
unless we have because right now market is pricing in no rate cuts this year. So it in fact means, and if you see even Powell's comment was that it is a fairly restrictive environment, moderately restrictive environment we are in. So if we are able to continue growth in this aspect, you can call it maybe a Goldilocks, but I would say it's still a pretty impressive means I would say innovation cycle, you can call it AI innovation cycle.
Okay.
Because remember that if in this fairly restrictive environment, we will still see a lot of sectors struggling outside tech. And even today, like last 2 years, a lot of sectors are struggling right now. I would call it Goldilocks if we have a very clear path where inflation actually comes down fast and we go down on interest rates also, which was actually post-COVID. The post-COVID was real Goldilocks when interest rates were almost zero and we were in a, all sector go up kind of cycle. So that from that perspective, even taking Amit's question, right, whether index investing or any stock will go up kind of environment which people have faced, that may not last very long. If we are when you look at the flat rate yield curve right now, the long-term and short-term interest rates are almost like coming at the same level. These are the environments which are fairly restrictive and not great for a lot of sectors outside the innovation sector.
Thank you. Yep.
All right, guys. So thanks a lot for joining, and we'll share the recording and let's keep doing these. It was great fun having these discussions. Thank you.
Bye. Good evening, folks. Thanks, Raman. Bye.
Have a good evening. Bye-bye.